Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global market reporter at Nasdaq. Joining us for this segment, we have Chris Englebert, founding partner and chief investment officer with Englebert Financial Advisors, for his 2022 outlook. Chris, it's great to see you as always. Welcome back to Trade Talks.
Thanks, Jill, for having me. Great to see you too.
And before we get into your outlook, let's talk about 2021, because it really was quite a year, not even in terms of retail participation and the trading volumes that we saw, but even when you look at sectors and cyclical trades, there was a little bit of everything for everyone there.
Yeah, it was a huge mashup. And actually, one of the things I think is really good is it really brought to the forefront. We got retail investors excited, interested again in the markets. I mean, I've got clients asking me all the time now, rather than being a passive, kind of spectator, they want to know what's going on and what's happening out there in the investing world.
Right. And, Chris, when we think about the market since even 2020, it really was those large mega cap stocks that have propped up the market here. Do you expect that to continue into 2022, or do you think we're due for some rotation here?
Yeah, I think that's going to be the theme for 2022, is you're going to see the rotation. I interviewed a really good hedge fund manager a couple of months ago, and he said something very prescient. He said, basically what happens is the same trade gets done over and over again until everybody's on one side of the boat. And he pointed out, and I agree, and we've seen it too, that these 5 or 6 large stocks that have been driving the markets the last couple of years and really accelerated in 2020 and carried over to 2021. I think really what's going to happen this time, the next couple of years going forward, is you're going to see a rotation into everything else except those famous FANG stocks: Facebook, Apple, Netflix, Nvidia, Google. People are going to, I'm still positive next year on the stock market, but it's going to be everything else. And I really like the small mid cap area as well, because that really hasn't participated like it should.
Right. And Chris, I'm glad you brought that up, because we do have this basket of 5 to 10 stocks that are really moving the major averages because of the technology component of each index. So if you were to get more diversified, let's say, in what's moving the market, wouldn't that overall be a good thing when you look under the hood and there's more participation, not just, 5 or 6 stocks that are driving the market? I mean, it's kind of crazy to think, as goes Apple, as goes the stock market. I mean, there needs to be some spreading of the wealth here.
Well, first of all, you're exactly right. And the thing that I keep pointing people back to is that in 2020, everybody hoarded their cash. There is still a tremendous amount of cash out there. Now, having said that, we could see a correction of 10 or 15% next year, because the last one we had was in September of 2020. But I think that's actually going to be an opportunity. And we're really focusing on some areas, like I said, in the small mid-cap space. But, what people haven't looked at for a long time is the biotech sector, and especially the small biotech stocks as well. There's a lot of innovation going on there. I don't want to get into the whole disruption theme, but there's some of these stocks are actually trading below the cash that's on their books. And it's really a story that's been missed. And it's one of the largest disparities between the S&P 500 and some of the biotech indexes that we've seen in history. So that's one of the areas we're looking at. But again, you're exactly right. I think the overall health of the market, at the beginning of the year, I was very positive. We saw small mid-cap stocks break out, and they've been in a sideways trading range literally the rest of the year. I think 2022 is going to be the year.
Right. And let's talk about the Fed, of course, and interest rates, really a big topic of conversation this week. But it all comes back to inflation. And I feel like that's really been the big narrative. We saw the market's reaction after the official word came out with tapering and 3 potential interest rate hikes in 2022 and some insight into 2023. We saw the market's reaction. I mean, almost hit all-time highs, but over the past couple of days, it feels as if traders and investors are kind of coming to terms with reality here. But it's just the price swings in general, Chris. I mean, you have the Nasdaq 100 as we speak now at 1 o'clock on Friday afternoon. It got back, into the, well, it's a little bit lower now, but it was in the green at one point. The Dow was down 600 points. Now, it's down obviously a lot less than that, but I feel like the moves have just been so extreme at certain times of the year here.
Yeah, and I think that's going to continue. And a couple of reasons is that if you look at the last 10 years, we've actually been kind of, ever since 2017, except for obviously March of 2020, February of 2020, we've been kind of in a low volatility era. And, people aren't used to that. And volatility historically as measured by the VIX has always been between like 18 and 20, 18 and 24. And we think that's going to continue going forward, that you're going to have a period of high volatility. And investors have to get used to that, because we think it's here to stay, especially for next year.
Right. So back to the interest rate conversation. Do you think, we know we're tapering, we're in the process of doing it now. Do you think we'll get those 3 rate hikes if we can't get inflation under control here?
It'll be very interesting. Now, here's my take on interest rates next year, and I probably haven't heard this from anybody else, but we study the markets a lot at our shop, and one of the things I always try to tell people is that when you have, and it doesn't matter what the asset class is, cryptocurrencies, stocks, bonds, when you have a tremendous volatility move. Now look at the 10-year treasury. In 2020, rates crashed from over 2% to under 50 basis points. And then in 2021, they backed up sharply. We've had a tremendous period of volatility in the treasury and interest rate markets over the last 2 years. My feeling is, and our projection for 2022, is that interest rates don't do a lot. Number one, if you look at all the cash that's out there at 0%, people are still looking for yield. Number two, from a global investor standpoint, the 10-year treasury still offers the best value out there. And number three, our black swan approach for next year is energy prices. If they do start to levitate and get over $100 a barrel, you could see a slowing down, during a period of the U.S. economy. So our outlook for 2022 is entitled Gas and Brake, where, hey, there's some good headline news, you're all on the gas. Hey, bad headline news, you're all on the brake. And we think that interest rates actually stay muted for literally most of the year. You can have the Fed raise the short end of the rates, but that can end up not affecting the longer end of the rates as well.
Well, Chris, it's real interesting. You sent me a headline at the end of November that JP Morgan sees oil getting to 125 in 2022, 150 at 2023. You're absolutely right. That really would be the brakes for the Fed. If you think inflation is bad now, can you imagine if gas prices actually did get to that level? So with all that said, how are you positioning clients going into 2022?
Yeah, we think 2022 could be one of those years where it's kind of boring and not a lot happens. We think the rotation out of the big cap tech stocks continues. So we're going every place else. Small, mid caps, our favorite space. Biotechnology for aggressive investors is really good. We think that there's going to be at least 10 or 15% pullback next year. We think that's going to be a buying opportunity. If the S&P trades flat next year and you literally buy a pullback and you're in some of these areas, it could be one of those years where everything but the big caps make names. And then we think we're not afraid of going out longer in the interest rate area because, again, we think interest rates are going to be very muted next year. And we are prepared, though. We do have a weighting in energy. One of the energy presidents came out and said that, their CapEx spending has been below norm. And energy still looks to be undervalued at this point in time, but that's kind of a hedge against higher oil prices, which could happen next year as a black swan event.
All right, Chris, we appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.